Welcome back to The Explainer, everyone. I'm absolutely thrilled you're joining me today because we're doing a full-on forensic breakdown of a phenomenally accurate market forecast. Today, we're digging into those structural calls made in late May that perfectly anticipated the early June 2026 market correction. If you've ever wondered what it looks like when structural breadth divergences, timing mechanisms, and institutional positioning all just perfectly align, well, you are in for a real treat. We're going to decode exactly how this market drop was called, literally days before it ever even materialized.
Right off the bat, let's look at the morning of May 30th. An email goes out from James Gaverty, and it says, quote, "I call today, June 4th, starting Monday, indexes will stall and start to move down and sideways." Think about that for a second. The crime, so to speak, was completely solved 5 days before the June 4th drop actually happened. So in this explainer, we're going to pop the hood and examine the exact charts and data points that made this level of precision possible.
All right, here's our roadmap for today. We'll start with the anatomy of the forecast, then look at the cracks in the breadth, dig into the composite market illusion, see how smart money fades retail, and finally we'll project the next pivot point.
Okay, part 1. Anatomy of a forecast. Let's open up the case file.
Every great forecast is really just built on a sequence of escalating signals. It's like a giant puzzle coming together piece by piece. Looking at the timeline, we move from the initial divergence right down to the execution. On May 23rd, the foundational cracks first showed up in the underlying market breadth. Then, by May 26th, our timing window narrowed drastically with a critical DMARC exhaustion signal. And all of that culminated on May 30th with a final macro warning via email, which projected June 4th as the exact inflection point. Let's break down each of these crucial days.
Moving right along to part 2, cracks in the breadth.
So on May 23rd, the surface looked absolutely fine. I mean, markets were hovering near all-time highs, the financial headlines were glowing, everything seemed great. But when you look closely at the SPY daily chart, the index retested recent highs in that 745 to 749 zone, and it formed a distinct double-top structure. The market was just desperately struggling to find the momentum to break and actually hold above that resistance zone.
But the real smoking gun, that was hiding in the pressure pains. While the price pushed back up for that second peak, the cumulative daily and weekly Williams A&D lines peaked early and started steadily sloping downward. It printed a glaring lower high. This massive underlying distribution highlighted that fewer and fewer stocks were actually supporting the rally. The big players were quietly unloading into the strength.
Now, you guys likely know this, but as a quick refresher, this right here is the textbook definition of bearish divergence. It's what happens when price makes a higher high, but an underlying breadth or momentum indicator makes a lower high. It basically tells us that the underlying buying pressure, which is the absolute necessary fuel for a legitimate breakout, is totally absent. And that missing buying pressure on May 23rd, that was the first definitive sign the rally was running on fumes.
By May 26th, the next piece of hard evidence drops in real time. A Slack message notes that the weekly S&P 500 just printed an 8 in the DMARC Sell Setup 9 countdown. And why does that matter? Well, printing an 8 signals an impending exhaustion phase, and it kicks off a highly critical 4-bar confirmation window that strongly favors sideways to downward movement. Basically, the timing window was snapping shut.
All right, Section 3, the composite market illusion.
This brings us to a super important dynamic. The stark contrast between what everyone thought was happening and the internal reality. If we isolate the S&P 492, meaning we subtract the mega caps like NVIDIA, Meta, Microsoft, and Apple, it reveals a clean DMARC Sell Setup 9 right at the turn of the month. After that 9 completed, a definitive combo/sequential countdown inflection triggered an aggressive downside reversal. By June 5th, this index plunged 2.04%, printing an initial sell setup bar 1 to officially confirm the structural regime shift. The broad market was completely exhausted.
And guess what? Even the seemingly invincible megacaps showed a parallel exhaustion profile. On June 5th, the Mag 8 daily index completely broke down, dropping a stunning 3.75%. But even more telling, the Williams Progo indicator pane plummeted deep into negative territory, hitting negative 5.70 cents. The daily Williams AD line also completely broke its critical near-term structural support.
So what's the big takeaway here? It's understanding the mechanics behind the drop. That massive dive in the Progo indicator exposes a deadly push-pull dynamic. It tells us that public hands, the retail traders, were eagerly trying to catch a falling knife, aggressively buying the dip on these megacaps. Meanwhile, professional, institutional money distribution was aggressively accelerating. Basically, the professionals were handing off the risk to the public right at the absolute top.
Which brings us right into Section 4, Smart Money Fades Retail.
The final macro warning hit our inboxes on May 30th at exactly 7:34 a.m., locking in June 4th as the inflection point. But how do you get the confidence to make such a rock-solid directional call 5 days in advance? It came from heavy reinforcement via institutional distribution metrics, specifically the commitments of traders, or COT data. When we break down the May 30th COT matrix, the hidden institutional positioning becomes glaringly obvious. In the Dow E-mini, the commercial net position, the smart money, was aggressively net short. We're talking negative 42,800 contracts. At the exact same time, speculator sentiment, representing retail, remained stubbornly, deeply bullish. And the Larry Williams 3-year COT index, it was sitting at a deeply bearish 22%. It was just a textbook setup of smart money fading the retail extension.
What you absolutely need to take away from this is how these different elements combine to create a trap, with market breadth drastically narrowing across the board, like we saw in those Williams 80 lines. This extreme commercial distribution created a classic false breakout setup. Retail buyers chased the index higher, but it failed directly into a massive, invisible distribution wall built by commercial shorts.
Finally, Section 5, the next pivot point. The June 4th call was flawless, but now we have to map out the immediate future using these exact same tools.
So what's next? Based on the structural momentum velocity of the Williams 80 line and the broader index cycles, our forward outlook suggests this current distribution phase still has significant structural runway. In fact, the models are forecasting roughly 8 more days of downward pressure. This trajectory points us squarely toward a critical reevaluation pivot around Monday, June 15th. Now, because of the high-velocity nature of these DeMark sell corrections, a temporary relief bounce is highly probable right there. But if that support holds, oh man, it sets us up for a really volatile liquidity flush and squeeze cycle heading into mid-July. As the S&P 500 E-mini futures broke down from that false breakout trap we talked about earlier, it started targeting lower structural macro support zones. The data suggests we're looking at targets further down, somewhere near the 49,200 level. And that area is going to be the critical battlefield that defines our mid-July macro outlook. Which leaves us with the million-dollar question, doesn't it? The data perfectly predicted the turn, and now it's handing us a date for the very next major test. When that June 15th pivot arrives, and the buying pressure inevitably attempts a comeback, is it just going to be a short-lived relief rally for trapped retail traders to finally exit, or is it going to become the launch pad for a massive mid-July squeeze? Well, we've got the charts, we have the tools, and now we know exactly what to look for. Keep your eyes on the breadth, watch the smart money, and I will see you in the next explainer.